welcome everyone to the final day of the XCC Bootcamp. Our first speaker today is Phil Kirk, the Vice President of Corporate Development and Cisco Investments at Cisco, and he'll be joined by his broader team in a few moments. Phil joined Cisco in 2007 and is currently responsible for all acquisitions and investments related to big data, as well as cloud software and management. Before joining Cisco, Phil was with Microsoft corporate strategy team. Previously, he was an associate at DTech Venture Capital, where he sourced and executed early-stage investments in the software and networking market. Earlier, he spent time as a strategy consultant, focusing on clients in the internet and e-commerce space. Also, a fun fact about Phil is that he is an amateur beer brewer. Please welcome Phil to start the session, Startups and Corporate VCs, Going Beyond the Investment. The stage is all yours, Phil. Thanks for being here.
Great. Thank you, Barrett. Thanks so much for that introduction. And good morning, everybody. Good afternoon. And really appreciate everybody joining our session today and taking some time to hear a little bit about what we're up to at Cisco and some of the experience and perspectives from our entrepreneurs and business executives and members of our venture team. So I'd like to take a moment just to introduce the rest of the participants that we have joining us here today. We've got an exciting panel. We have Omar Tawakol, who is the Vice President and General Manager of Cisco's Contact Center business. And previously, Omar was the CEO of Voicea, which was a Cisco Investments portfolio company, which was acquired by Cisco in September 2019. In addition, I'm joined by Ari Winkleman, who is the founder and CEO of Involvio, one of our current portfolio companies. And lastly, I have Efrat Noy, who's the global lead for our Cisco Investments platform group, which works very closely with our entrepreneurs and portfolio companies to help them accelerate their business plan within the context of the Cisco ecosystem. So I know Omar, Ari, and Efrat are excited to answer some questions and share a little bit about their experience, but I wanted to take a minute and talk just about what Cisco Investments' approach is and our objectives when we think about venture capital investments. Our strategic investment capability at Cisco is really a core pillar of our overall approach to innovation. Our startups and our venture portfolio help us track emerging technologies, anticipate market disruptions, and engage directly with the startup ecosystem to help create value for Cisco, our customers, and our partners. On the venture side, we've been active for quite a while. We're one of the most prolific corporate investors. We've been deploying capital for over 20 years. Our current portfolio has over 120 startups in it, and we manage approximately 250 to 300 million incremental deployed capital per year. So about $1 billion of deployed capital, if you think of it as a typical fund. Our investments cover a broad spectrum of technologies and regions, and we're investing around the world, including places like Israel, Europe, China, India, and Latin America. We invest in all stages and check size, and we really have two philosophies in mind when we think about an investment. What is shaping the markets that Cisco is in today? And that would be things like networking, security, and collaboration, as well as what are the next horizon opportunities that might drive new disruptions and new innovations? And that could be spaces like artificial intelligence, augmented reality, or machine learning. What we believe differentiates our team as a venture investment organization is that we blend acquisitions, M&A, our expertise there, with our venture experience, with our business development expertise to help accelerate all of the companies in our portfolio and help them see the best outcomes, both as part of the Cisco ecosystem and on their own. And we always try to leverage these insights that we gain from our portfolio companies to help inform our strategy and assist our business units as they think about market transitions that they're working through. So with that as a little bit of background and context, let me kick off our conversation here. And maybe I'll direct our first question to Ari, who is the CEO and founder of Involvio. Ari, you've been part of our investment portfolio since 2017. Tell us a little bit about that journey. What does it look like? And what have been some of the high points of that experience?
Phil, thanks for having me. It's been quite a journey. For us, we were after a couple of things in partnering with Cisco and ultimately bringing Cisco on as an investor. Ultimately, we were after growth. And for us, we sell exclusively into higher ed. We offer software that helps higher ed solve its most, what was and will soon again be its most pressing problem, student retention. And for us, we had developed a lightweight solution around student engagement, and we were looking to level up to ultimately get to a higher level decision maker inside of our customers. And partnering with Cisco brought us directly to the CIO. Which is someone who had never engaged with us before. And at the same time, working with Cisco over a couple of years, we saw our deal sizes increase 10 times. The deals we were doing on our own were small. The deals that we've been able to do together through integrations with Cisco and ultimately through Cisco's go-to-market engine grew 10 times. So for us, the journey's been unbelievable, but it's really been one that we've had to invest heavily in. Obviously, Cisco's invested capital in us, but we've invested a tremendous amount of time in Cisco. And what we found is that in order to really get the most out of the journey, our entire team has had to really think deeply about, what are the ways that we can help Cisco and what are the ways that Cisco can help us. And what we found is everyone in the various BUs has been pretty excited to work with portfolio companies and really on many levels taken us and our entire team under their wing.
Awesome. Thank you, Ari. That's great. Efrat, I want to come to you next to talk a little bit about portfolio development. Can you give us a bit of a summary of what the portfolio development team is all about and how you try to focus on delivering value? And maybe what's the number one thing that you think that corporate VCs can try to offer to entrepreneurs?
So the portfolio development team inside of Cisco Investments is really about leveraging Cisco's presence in market, Cisco's access in the market, and bringing it, or some of it, into the portfolio companies, thereby kind of connecting between the startup ecosystem and our portfolio and Cisco's go-to-market, which a lot of times means our access to the customers, our access to channel, our access to our sellers. And so the way and thereby providing growth for companies such as Ari's or such as Omar's or in our entire portfolio. The way we're thinking about this is we believe that every company is unique. Every company kind of works in its own segment. Every company has its own journey and stage. And so we really try to tailor a certain program for each and every company that again would make sense of Cisco's go-to-market engine and really make use of it. And again, every company is very different. In the case of Ari's, we really kind of leaned forward and brought him into the BU and our sellers. In the case of Omar, we really brought Voicea to the buyer, and that kind of applies to all our portfolio wherever they may be. You were asking about the number one thing that corporate VCs can give a startup. It's really, Phil, about access, right? Access to the right type of buyer, access to the right type of seller, access to guidance around how to provide an integration and how to run with an integration with Cisco. Access to the business unit when it makes sense to create that integration. Ultimately, we think about growth, we care about our portfolio companies, and we'll give that access as it makes sense.
Awesome. That's great. Thank you. Omar, I would love to bring your perspective into this discussion. And you've got a pretty interesting one because you were on the entrepreneurial side twice and then are now here at Cisco. Could you talk to us a little bit about what that journey has been like, and maybe how does your perspective of having been a founder affect how you think as a general manager at Cisco about working with startups now when they're in the investment portfolio?
Yeah, glad to. And just a quick comment, when we were running Voicea and partnering with Cisco, where Cisco is an investor, at the time, we kind of had a fortunate situation in that Cisco was an investor, and so was Google, and so was Microsoft, and so was Salesforce. And one of the things that, I took away from that experience was that if you're really, really aligned with both the product sets that that investor has and the go-to-market motion that they have, if you just have those couple of things, so much of the other aspects are going to fall in place. I remember, meeting with Efrat when I was, early in the days of Voicea, and we'd be invited into these kind of very strategic customer presentations where we were just so aligned, because our mission for Voicea was to change the way meetings were done to make them more productive. And WebEx's footprint was in, the majority of the largest enterprises, on the planet. And they had the decision makers who cared about how productivity was improved in their organizations. It fit with WebEx. The sales team cared. People would get compensated better if, we showed up, because it would help them sell. Like, everything was just alignment. So the main takeaway I'd say is, if you're looking at corporate investors, look for the alignment. Everything else follows. There are a ton of other benefits, but that one I think is dominant.
Yeah, that's great. That's awesome. So, Ari, maybe let me come back to you for a second. You've raised money from corporate investors as well as financial investors. And in the CEO's mind, how do you think of your expectations differently when you're engaging with a corporate investor versus when you're engaging with a financial investor?
Yeah, sometimes the expectations are the same, because corporate investor is also a financial investor. But there are certain things that a strategic investor, in this case Cisco, is able to provide that a financial investor can't. For example, I wouldn't look to one of my financial investors to provide me with security guidance, or even on some levels, product development strategy, or insights on product roadmap. I think for us, what we're getting from Cisco is almost a direct line into the decision maker inside of our accounts. Because Cisco has an enormous field who's out there in front of our customers every single day, and ultimately needing to sell their own products. And for us, that yields a very different market perspective than our financial investors could provide. So on a lot of levels, we think about the insights that we're getting from Cisco as sort of like not behind the scenes, very much whatever the opposite of behind the scenes is, on stage, I guess. And our financial investors, these guys have built and sold tons of companies, and so we look to them. We look to them for guidance about sort of general startup dynamics. But our financial investors actually often look to Cisco for guidance, because Cisco is bringing us deals, and there's nothing more important than that.
Yeah, revenue is pretty important, it turns out, right? For everybody. Omar, I want to come back to you with a question. Thinking about somebody like Ari, Ari was describing how he really worked to find the right advocate inside of Cisco where you could get that alignment. Now that you are someone who has been on the outside, but now, Omar, you're in the machine, so to speak. What advice do you usually give to entrepreneurs and founders when they're trying to chart their path inside of a big company, and maybe they don't have someone like Efrat to help them as a Sherpa? How should they go about doing that, or what should they be looking for in finding the right internal ally as an entrepreneur?
Yeah, that's a really good question. I mean, the first thing I would say is, regardless of the particular human who would become the ally, because that relationship is going to become very important. More important than that is the structural alignment on the product, so that the end customer gets the benefit, and then the alignment on the sales teams. Because let's say, for example, that you found a really good advocate who really likes what you're doing, but you're just not as aligned in the product and the compensation models. That advocate, what happens if they change their role or they change their job? So I think the first order of business is is the alignment fundamentally there? Because after that, it's kind of like downhill skiing versus, climbing up the face of Half Dome. So the second thing I would say is, yes, find that relationship, because of course, if the structural alignment is there and you don't have a good partner, that would be hard.
Got it. That's helpful. I think that's good advice on the product. Look for the product fit. And if you can have natural product fit, then maybe that creates that downhill skiing momentum you're describing. Efrat, let's think about building on that in the context of portfolio development. So how do you try to help chart a path for an entrepreneur if they become part of the portfolio, and if it seems like there is that product fit, but now they're wondering how to take it to market and how to get it in front of a customer? There's so many different avenues at Cisco for us to reach customers. Tell us a little bit about how you sort of lay out those options, and then maybe what criteria you think are the most important when a company is choosing to prioritize where to put their efforts.
Yeah, that's a great question, Phil, because you're absolutely right. With a company such as Cisco, in its magnitude, it's really hard to one, navigate, and two, really choose what order is correct, right? And what order to choose from, and how to prioritize. I will say, though, that from a navigation perspective, that's really, one of the values that we provide. Omar was alluding to, connecting with a certain person. When you're from the outside, right, and you're kind of knocking on Cisco's door, it's really hard to understand who's who in the zoo, and who to go to, and who are the influencers. And I see Omar smiling because it is very true. And one of the things that we do is we try to keep tabs very consistently around who are decision makers within the business unit, within our sales organization, within various business units within Cisco that may be relevant for our portfolio companies. And so we really try to keep tabs around, how is the organization changing, and who are the real stakeholders for any type of portfolio company. So that's something that we have in our minds, we have in our structure, and we have those relationships and that rapport with these folks in order to influence them to, view and promote one portfolio company or another. And we do this in every business unit. So whether our portfolio is in security or in the collaboration space, such as Omar's, or in networking or IoT, we always keep tabs on who is the decision maker, and how do we get to the right folks in order to determine that alignment, or even more so to create that alignment with Cisco. So that was so that's one thing. The second, so when we meet with a portfolio company, or when a new portfolio company comes in, we really try to kind of map out who should they be speaking to, right? Or who are the main stakeholders? That's the primary thing that we do. The next step is really to understand in a very, very deep manner, who are they? What does their product look like? What stage of a company they're in, how big they are, how big is their seller organization, how well can they, and in generally, how well can they fit, not only from a product perspective and a potential integration that the portfolio company may have in mind, but also with the go-to-market side, right? How can they align with our seller organization? How can they sell to the sellers, to the Cisco sellers, in order to promote their product in market to the customer, and potentially even to the channel? When it comes to that, this is really an iterative process. So we may start out with a certain plan in mind, which will work kind of hand in hand with the portfolio companies to define. There is, in many situations, there is a step process, right? So in the case where, there can be a very strong integration or joint solution in market that could be done, there is a step process in order to do that, right? So we have to get them into the business unit. We have to, do that integration. But then next comes kind of the go-to-market alignment, which sometimes there's kind of a parallel process to that. but that kind of goes hand in hand. And again, it's an iterative process. We refine it as we go along and as we move towards, or within it in time.
Yeah, that sounds like you have the secret. You try to create the secret decoder ring for the entrepreneur.
Absolutely.
To chart that path.
Yeah.
Ari, let me ask you a question, and then also Omar, you may have a comment on this. Ari, when you were thinking about corporate investors, you're in the education market, and there's a ton of investors that really care about and prioritize that market. Did you think about raising money from more than one strategic investor? And how did you, as an entrepreneur, kind of juggle that decision-making process? And then maybe, Omar, we can get your perspective on that question as well.
We went a non-traditional route as an ed tech company. If you're an ed tech company, you probably want to raise from an ed tech VC and some ed tech strategics. We tried to stay as far away from the ed tech strategics as possible. This may be a controversial view, but we essentially saw the world of ed tech is all about, many worlds are all about disruption, but ed tech especially, the vast majority of success in historical ed tech has really been publisher driven and textbook driven. But that's a business that is still trying to figure out why it exists or why it still exists. And for us, we didn't really want to align there because the buyer of a product from a very large historical ed tech strategic wasn't the buyer that we were going after. We were ultimately going after a technology buyer driving digital transformation on campus. And so for us, it was obvious that was Cisco's customer. And when we looked at other strategics, what we found was that many other strategics were trying to figure out their approach in education, but Cisco was already there with the network and WebEx installed on campus. They were already the trusted partner. And so what's happening now is many other strategics are after us, looking for us to integrate our offerings in a similar way to the way we've integrated with WebEx and with the network. So we wouldn't necessarily be averse to having additional strategics in. I think Omar's story is quite an inspirational one, having many strategics at the table. But for us, thinking back to even Omar's guidance about having real alignment with not just the field, the sales team, but ultimately with the customer. At least in the early days for us, when we were small, still quite a small team, but when we were an even smaller team, would have been almost impossible for us to support multiple architectures, support multiple integrations, and to lean into more than one relationship.
Got it. Thank you. That's helpful. You had to, and you were pretty early, so you had to prioritize. Omar, how did you juggle those different relationships, and are there any takeaways that you think are helpful for this audience?
I'd like to say that we had sat back on day one and thought through exactly how it would play out, and it played out much faster than we'd expected, because before we had even left our day jobs and founded the company, we had one strategic investor interested. And then by the time we kind of were actually in the company in January 2017, I remember there was like 3 of us at that time. We already had a strategic investor. And then after that, a bunch of interest followed through. So how did we think it through? I think every investor's job is to convince you that their money is different. And my perspective, if you don't mind my saying, as a recipient of that money, is all money is green. So you need some other advantages other than that in making your choices. And so when we looked at the different investors, we got something very different from each. So in terms of Cisco, we had alignment with the end buyer. And if you're thinking about an end buyer and you're doing some sort of meeting productivity solution, you're essentially not going to want to log into multiple tools at the same time. You want it deeply integrated into the tool. So if there was a way to deeply integrate into WebEx, and we knew there was, we knew that we'd get the alignment. Whether we'd succeed through the partnership or not was yet to be determined. In the end, we did. But at least we knew that the alignment was naturally there. If you looked at someone like, a Salesforce, they brought us a different type of buyer, which we had a thesis would be very aligned. And in the end, it was just, okay in its alignment. We looked at Google and Microsoft, and actually what we were looking for them was hope that it would align and result in market momentum, but knowledge that it would appeal for our hiring of developers. We were after the world's best AI developers, and being able to say you had Microsoft and Google invested in your AI company made it easier for us to pull engineers out of the top companies, which we essentially succeeded. So we got different credibility in hiring and in acquiring customers, in hiring developers, in kind of partnerships from the different companies, and it just rounded out so nicely.
That's awesome. I mean, it sounds like you played a great balancing act there, and maybe it was iterative over time. Maybe just to kind of build on that, and then I guess there may be some questions from the audience, and Barrett may be collecting some of those, but we have entrepreneurs and founders here on this call. When do you think they should engage with strategic corporate investors? Should that be something that they do? And there's two pieces to that maybe. One is a stage question, which it sounds like, Omar, it turned out you were fairly early, and I know, Ari, you were fairly early. Do you feel like that was okay? Or would you recommend people wait until they're later? And then in a given funding process, some people might say, go get a term sheet first, and then go talk to your strategics. And others would say, well, strategics are corporate sometimes, and maybe they take a little longer, so maybe you need to start earlier. What stage, and then within a funding round, what timeline would you guide an entrepreneur to think about? Omar, maybe do you want to comment first, and then Ari, would love to get your thoughts too.
Yeah, so conventional wisdom says do it later. That didn't happen for us, and again, it wasn't because of strategy, and I won't say the name of who and which, but it was the CEO of one of these large public customers, famous CEO, who emailed me. And at the beginning, I literally thought it was one of my friends pretending, like just doing a joke. Because the email is like, hey, I heard you're doing another company, can I invest? And I was like, okay, this has got to be a joke. He's obviously too busy to be sending me this email. It turned out not to be a joke. And so clearly when that kind of opportunity from the top comes, yeah, don't walk away, whether you're ready or not. It opens doors, and it did end up opening doors. But in general, because that's not the usual circumstance, in general, I would say wait till you know that there is alignment. Not that you've taken that alignment down to, okay, I know exactly how to go to market and all that stuff. I just mean that the natural alignment is there. Then you can take some risk and say, let me do the investment knowing that this might take 2 years to develop or might take 2 months, but I know the natural alignment's there. As long as the natural alignment is there, I think it's a good thing to do. Some people are worried that when the investor comes in, that they're going to start controlling your roadmap, that they're going to start doing all those things. I didn't find that. Nobody controlled our roadmap. No one kind of asked us to do things that were unnatural to us. And if they asked us to do things we didn't want to do, we just said no. Like the investor wants you to succeed. They're not there to just make sure you only succeed for them, because they're also financial investors. They want to succeed and they want their reputation to be good. I just wasn't that worried about some unwelcome guest coming in and running, control over my go-to-market or my roadmap. So it kind of worked out fine.
Awesome, that's helpful. I like that. If you're worried, just say no. Seems pretty straightforward. Ari, is it that easy, or how did you think about when to engage with strategics, and then maybe in the round dynamic, did you go early? Do you wait till the end and you got a term sheet and then you call them up and you say, hey, I got a little bit left, do you want a piece? Or where was your head on that?
Yeah, for us, the opportunity from Cisco kind of came out of nowhere, and we were highly opportunistic, and we leveraged the opportunity from Cisco to close a larger round. So for us, this is my first startup. We didn't quite understand what the relationship with Cisco would be like. And we certainly could have been more strategic about timing. But the most important thing for us was to raise when we were raising. So looking back, I would say that the big thing that I wish I had known would have been this sort of gestation period that building some parts of the relationship take. So the most important part of our relationship with Cisco for sure is leveraging Cisco's sales engine and putting the pieces of the sort of sales program in place to take a significant amount of time. And you've got to stage them. So, if you've got some incredible ideas, or if you're, the BU has some incredible ideas around opportunities for integration and joint value to customers, it's going to take some time to build that integration. If you want to get on a resale program, it's going to take some time to get on a resale program. And so for us, it took us probably a year to deliver a really tight integrated product that was really harmonized so that the field could sell it, and also to get our products onto the Cisco price list. So I think, we might have put some of our activities in a different order had we realized the time that some of the piece of the relationship would take to build. But I think the best advice that we've gotten from the Cisco Investments team, and I think to Omar's point about not having someone sort of in your business calling the shots, the best advice we got from Cisco Investments was basically like, if you hear something from Cisco, don't do it. Just like, don't do it. If you hear something from the customer that Cisco presents to you, then do it. And ultimately, that's yielded a really great product and a really great partnership. And ultimately, Cisco Investments has been kind of our guardian angel inside of Cisco, ultimately helping us to understand, like, how do we get growth and how do we make sure that investors recognize that Cisco's not looking at us and trying to direct our roadmap, but they've got financial interest and they want to leverage what makes them different to help us grow.
Yeah,
Hey, Phil,
that's good.
You asked both of us one aspect. I think we didn't dive into the answer, which is around a piece of the timing. Generally, what I found is that the financial investors want to set the price and terms a little bit faster than the corporates. So you want to do that. On the other hand, having a corporate around the table, even before that's settled, makes the financial investor more eager. Because right, so it's there's a little bit of a sequencing there.
Got it. Yeah. So the sort of game theory of the round, if you will, it sounds like get on the radar, or one approach would be get on the radar of the strategic, then engage with the financial, and you can always use the interest of the strategic as a sort of qualitative market validation point with the financial investor. If they then give you a term sheet, it might then get the strategic off the fence to chip in as part of the round in some instances.
Exactly. Yeah.
Okay.
Yeah. And I'll add to this that in terms of accelerating the financial investor's interest, we had one financial investor doing diligence. They had a call with Cisco. Cisco shared experience talking to Cisco's customers who are joint customers of ours. Financial investor didn't even call our customers. They said this was a reference call.
Well, that's good. That's an interesting. There you just short circuited the process, Ari, even further, right? That's great. So Barrett, I don't know if we have any questions. If we do, we could take them now, or we could talk a little bit about stage and get Efrat's view on working with companies at different stages.
Why don't we take a couple questions here, and then we'll come back to that if there's time. How about that?
Sure.
So actually, this has been, in the words of AFI501 on our chat box, a bloody awesome discussion. So super interesting. I'd like to call on Afnan, who is the person commenting there. Afnan, would you like to present your question verbally?
Yeah, sure. Thanks for that, Barrett. And thanks a lot, guys. I'm in Cambodia at the moment where it's around midnight, so haven't got my video on. Basically what we do is IoT for microgrids, right? Basically automated microgrids in villages where there's no electricity. And one of the things that we've been looking at recently is getting on board one of the big strategic investors who invest a lot in the energy business, like massive energy projects, right? Like tens or hundreds of millions of dollars. But some of the advice that we've got is you need to pick really wisely, because pretty much you've only got one shot. Hypothetically, if you go with Shell, then BP or Marubeni won't necessarily want to also invest. So this question's for Omar, and obviously you managed to navigate that situation. And when you want to bring a bunch of these guys on at the same round, how can you, dodge that minefield to get that outcome of all the aligned strategics at the same time?
Yeah, so I didn't I hadn't heard that you only had one bullet wisdom. That dynamic didn't play out for us, and it might be unique to a particular industry. And I just wasn't there because our play was a little bit more horizontal. And I think you always want to leverage scarcity on your side, which is you want to be in a position where you have choice of lots of money, and you want it to be clear that I'm sorry to say this with Cisco Investments team here, but you want the different investors to feel like they might lose this opportunity because another investor might take it. That's your game as the CEO of a company, is create that scarcity. It'll give you better terms. It'll make people sit up better. And when they sense your leverage, they will like you more. It's a very interesting dynamic. So I think it's, if you can be picky about who you bring in, that'll set up the right dynamic, and you might just get lucky and bring multiple people in. Now, that pickiness and that kind of game theory I'm describing can't be all bluster. It has to be that you actually have leverage because you're onto something really good. The market is good. Your team is good. The technology is good. That's ultimately what gives you leverage, not just, gamesmanship. So anyway, I hope that kind of gives a sense of how to try to get multiple people to compete for what you're doing.
Cool. Thanks, Emma.
Might Ari have something to add on that same topic?
Yeah, I agree with Omar. There's no reason not to have multiple strategics unless this is customary in your vertical. The only challenge, I think, in our experience is, we sell a tightly integrated product with Cisco, and ultimately, the reason we've seen growth through resale is because Cisco sellers are using our product to differentiate against Cisco's direct competition. And so we've decided, at least for now, not to integrate with competitive products to Cisco because the Cisco seller doesn't want to lose a deal. If they introduce our product to their customer and their customer chooses to buy an inferior product to Cisco because they love our product, and our product would also integrate with that other product. So I think that when you're thinking about raising corporate money, you should kind of think about the strategic relationship and the money and the future relationship as three different thoughts. So in our world, that's what we did. But I think the more options you have at the table, the faster you can close a deal, and the more future opportunities you're setting up for yourself.
One thing, Barrett, just to add to this, that I think Ari and Omar mentioned when we were discussing this earlier, was it also depends on the people, right? I think, Ari, you mentioned the personal relationship with the individual on the other side of the table. Even though these are big companies, it always still comes down to the people. So perhaps in the case of the entrepreneur earlier, laying out if your goal is to be able to work with multiple vendors because your product wants to have a platform capability, finding the person that you want to work with makes a big difference too.
Yeah, could I comment on that? We worked with Donald, and Donald's just fantastic to work with. He is, what you see is what you get. He tells you as it is. I've now worked with him on the other side here, and it's the exact same Donald. And it was, I learned that from my first time around. When I built BlueKai, my first investment in was Redpoint, a gentleman named Chris Moore. And man, that guy was just so awesome. And he stayed that way during the investment, during hard times, after, we got bought by Oracle. And kind of my same experience with Donald tells me at the end of the day, it really is that person that you're going to be aligned with. Once in a while, you have an investor where that particular person moves on and somebody else takes his place. So at the end of the day, the company matters also. But if you're lucky and you stay with the same person the whole time, as I did with Donald and Chris and others, it makes all the difference.
Right
Yeah,
on. So, go ahead.
Phil, can I just add one quick comment around Afi's question? You know, I think when choosing a corporate investor, it's really like Omar was saying, all money is green, but it's really important to examine which corporate would get you to that alignment that Omar was talking about, and which corporate would get you to the right type of buyer, right? You know, when you do talk about corporate or strategic investors, it's really important to examine what is their ability to influence the entirety of the company, right? And how able are they to mobilize the company to get you to your objectives?
Right on. All right, so let's move on to JP, also joining us from Southeast Asia. JP, do you want to go with your question?
Yeah, thank you. I'm in Indonesia, so FinTech Indonesia background. That's our association. So my question actually was kind of a follow-up to the previous one. So if a company is already in a relationship with a corporate venture capital strategic relationship and is having a shared go-to-market, do you have any advice or any guidance in terms of how to avoid conflicts in the go-to-market between the principal sales force, right? And then obviously the investee company's sales force, because basically you got two different sales forces going out there. Do you have any guidance on how to like align those and avoid kind of principal versus investee company go-to-market conflicts?
Phil, maybe I can take this one. So we are selling direct and through Cisco. And the worst thing that you could possibly do is cannibalize your resale channel by having a different compensation path for your direct channel. So for us, what we've done is we've basically decided our internal guys are getting paid on deals that come in through the resale channel. And that's been great. Because ultimately, you know, if you've got an internal sales force working with a much larger channel partner, you want your internal sales force acting as almost product sales specialists to support that larger channel. You don't want them fighting, because if they fight, then you're not going to close deals in front of your customers. So ultimately, as I see it, in our experience, you've got to really think carefully about compensation, and you've got to be sure that no one is disincentivized to not do a deal, or disincentivized to do a deal.
Yeah, Ari, I totally agree with you. I think said another way, just be prepared to overpay early on in your history. Don't worry about optimizing your margin there. Get the salespeople aligned, get the buyers happy. And over time, you can figure out how to maybe streamline so you're not overpaying. But really, in the beginning of your cycle, you should just be caring about growth and happiness of customers, and optimizing how you pay your sales force at the risk of creating dissonance isn't worth it.
Right on.
Thank you. Very helpful.
Cool. Thanks, everybody. I have a question. You know, we've been talking a lot about alignment, right? And how important that is between creating that relationship between a startup and a corporate venture capitalist, especially. And creating and building and finding that alignment really starts with moment one and conversation one. How does the pitch, the initial conversations between a founder and a corporate venture capital, how is that different than a pitch to a normal or institutional financial VC? What do startups and founders need to do before going into an initial discussion with the corporate venture capitalist in order to help them to find that alignment as soon as possible? I
mean, I would step back before your first meeting and just think through, why would someone on the sales team in some product org in that corporate investor really get excited about your product, thinking that this would help their customer and help them selling something to that customer. If you can think it through to that level of detail, that's the only part of your pitch will change. You're going to pitch your company, and then you're going to explain that last mile of it, which is why that corporate investor is going to care and why the buyer of that corporate investor is going to care, and why the salesperson care. If you could think it through to that level, I think you're in good shape to have your first meeting.
Right on.
And we actually thought it through backwards. So we probably should have looked at it through the lens of the buyer, and ultimately, looking at the buyer through the lens of Cisco sellers. But in our experience, we thought about it through the lens of our user. And ultimately, we looked at Cisco's portfolio and we saw really deep video integration opportunities. And we were pretty early on into, even today, none of our competitors have video integrated. And that served us really well going into COVID. And we never anticipated that video would be so important. But very early on, we happened to hear about video integration opportunities with Cisco, even before Cisco Investments came and approached us. So for us, we thought, how can we improve our product? And we thought we need video. We happened to meet Cisco, and for us, that's really what clicked. It was really sort of like, what kind of core functionality can we deliver that's going to be sticky for our user and make our product better?
Right. Good point. So all starts with your own user, understanding them and how they may be, or how they may better access your own product. Actually, let's move to Shuemei, who is joining us from Ireland. Do you want to ask your question directly, Shuemei?
Yes, I would. I did turn on the video here as well. Hi guys, how are you? This is Shuemei. I'm the CEO and the founders of Microgen Biotech based in Ireland. So basically we use the microbiome, so natural microbe to reduce heavy metal from rice and wheat crops to increase the people's health by eating food. So I have a question here. We just finished our Series A fundraise, and they're all financial investors from venture capital, and we did get lots of interest from corporate ventures. And we actually decide, okay, it's an early stage, and we are not put effort to reason from them. And then the main reason, I suppose, from our current investor was saying it's too early and we don't want to be captain, or it's impact our next round of investment or exit. So the basic question I'm going to want to ask you, probably in next round, we will bring the corporate venture into our company. But generally, we're thinking, what kind of the range percentage when you bring the first, like a corporate venture, like investment? And if it's too high or too low, how that impact for your next round, and also how that impact for your exit?
I think the beauty of corporate investors is they're not as demanding on percentage ownership as the financial investors are. So you have some really good flexibility there. Most corporate investors have ballparks on what they want. And your job as a CEO is to create so much leverage that you can even get them to bend what they want. But I haven't even found that to be a problem, because I find that corporates are just more flexible. Like, you'll speak to a financial investor in Series B and they'll say, hey, well, our goal is to get X%. Right. And it tends to be a larger percent than maybe you're comfortable with. The corporates won't play that game. Some of them are going to put some requirements, but like I said, as much leverage as we have, those requirements become smaller and smaller.
Okay, that's good. So you're basically saying, like, get a good leverage and competitions into the round, and then balance the percentage. Great, thank you.
And I think the thing to stay away from is lots of tiny investments from corporates, because that's not useful, because what you get there is they're not that aligned because they didn't put much skin in the game. They have reporting requirements, and now you have an overhead to deal with. So there's a balance of, you definitely don't want to you don't want to treat a corporate like an angel, because they're not. They have to be managed, and you want to gain advantage from them, which means you have to put time into them, and you don't have infinite time. So few really good ones is kind of the useful thing, and they're not going to take. They may take a lot of percentage because they're interested in taking more, but they won't require it.
Okay.
I don't know, Cisco, maybe you have a different perspective there. You know better.
No, I think you raised a good point, Omar, which is that there is overhead in taking more investors. It's more cats to herd on your cap table, right? And I do think you raised a good point, which is as corporate investors, we do care about, we do care about financial returns because our CFO and our shareholders care what we're doing with the money, but we don't have to deliver an IRR on a fund the way that a traditional financial investor does. And at least in Silicon Valley, lots of times financial investors will say, well, can I return the whole fund on this company? And if I can't, then it's not worth my time to invest. And that's not how we think about it. We're willing to invest at different stages. We're willing to invest with different check sizes. And I think that allows us to be more flexible, perhaps, than some financial investors.
That's great. Thank you, Phil and Arma. Thank you.
Thanks, everybody. Let's move to Joy, who has a question.
Sure. We do point of care testing for everything from cows to COVID-19. In your earlier comment, you referenced corporate requirements. Can you talk a little bit about what sort of corporate requirements you've seen from strategics that you want to make sure you have leverage to avoid? And in the case where they're also part of your distribution channel, do you have a separate distribution agreement with those strategics?
Yeah, actually, just let me clarify one part. When you talk about a distribution agreement with that strategics, do you mean in terms of the business deal?
Yes.
Okay.
So they're your sales channel. Have you kind of separated that from their investment as a strategic?
Absolutely. They generally will be separate. The timelines that you need to do an investment versus to get a good corporate deal, they're not aligned. They rarely will ever be aligned. They'll be completely different deals. So you'll have freedom to, negotiate that in the way that you need to, recognizing that if it's their distribution, of course, they'll have leverage. But in terms of the corporate requirements I'm talking about, there's essentially of two types. One is for the investment itself. Some of them may come to you and say, hey, I need X%. And so I want to invest a certain amount. And again, if you have leverage, you can get them to bend from that. If you don't have leverage, you might not succeed. And in general, those requirements won't be onerous, I've found. But the second one is information requirements. They're going to want you to report in a certain way. And another corporate investor might want you to report in yet another way. If you're early on, you might not yet have a CFO. And you just don't have the time to do a lot of that. So we had an outsourced finance team that was really good. And I just didn't have that kind of time. So kind of allocated to them, and they would wrestle down our finances and make sure it fit into kind of the reporting requirement that investor had. So that's just my warning to say, recognize that there is some management overhead. So you don't want to do too many of these. And, as Ari said, he put significant time into making sure the channel worked and worked really well from him. And he couldn't have done that if he had, 5 of them.
Sure. Okay. So you weren't referring to any kind of, hey, we're a strategic who's going to bring extra value, therefore we should get extra commensurate value.
That might be implied in the way people speak, but at the end of the day, no. At the end of the day, they bring leverage, you bring leverage, and they're not going to be, hey, well, because of my investment, you need to give me an extra point on the business thing. They didn't do any of that.
I would say just on that point, at least from a Cisco standpoint, we try to keep them sort of ships in the night. Like both deals have to make sense on an independent basis, and I think you're not setting a good dynamic with the entrepreneur if you are sort of like quasi abusive out of the gate in the way you try to link those two together.
Yeah, and we just didn't find that they weren't like that at all.
Yeah, and I'll echo that. We also didn't find that at all. And the deal, we have many deals with Cisco. We've got, obviously investment deal, distribution deal, and some other licensing deals where Cisco has licensed some of our technology. And all of these deals are completely independent, signed by different legal teams who don't know each other. And ultimately, having Cisco as an investor actually helped us to get those other deals done, because it provided some sense of almost like kinship. I think the guys who we cut these distribution and licensing deals with felt, well, Cisco Investments is behind these guys. They must be doing something right. We should also do a deal. And when we ran into some rough patches in negotiations, we were able to bring Cisco Investments to the table to help us get to the next juncture. So we definitely haven't felt any onerous terms whatsoever from any part of the business. Obviously, everyone wants to negotiate, but these are separate, at least for us, separate initiatives.
Yeah, and just to add something to what Ari is saying, having the insider, someone like an Efrat or Donald or someone to help you understand, for example, we saw the security requirements that Cisco had when we were going through the integration. We're like, oh my God, that's like a very stringent set of security requirements. And the Cisco team said, look, that's the thing you don't want to negotiate. We're not going to bend the rules on security. So just put the investment in that. And, it's good for someone to tell you, hey, this is negotiable, and that's not.
All right. I think that we're coming to the top of the hour. Thank you all to the Cisco team for joining us today. Phil, if Stardust would like to get in contact with you or your team, what's the best way for them to do that?
Yeah, well, the easiest way is we've got a website, ciscoinvestments.com, that shows everybody on the team and our existing portfolio companies, and there's an email address at the bottom there. Or they could shoot me an email directly. It's just phkirk@cisco.com.
Awesome. Thank you all so much. Thank you, Phil, Efrat, Ari, Omar, for giving us a behind-the-scenes look into corporate venture capital at Cisco. I'm certain this was super valuable for all the startups in the audience, judging by many of the comments on the chat box as well. Thanks for being with us. And thanks also to Cisco for being an ardent supporter of XCC overall.